A warm welcome back to the channel. So in today's video, we are going to go and look at what ICT spoke about in his second video, which is the ICT Mentorship 2024. We are going to start by going back a little bit into what we discussed previously in our video on this channel. If you haven't watched it, go and watch it. We'll then move along, and then we are going to discuss buy-side imbalance, sell-side inefficiency, which is the BC. We are also going to discuss sell-side imbalance, buy-side inefficiency, which is the CB. Then we'll talk about liquidity and inefficiencies. So without further ado, let's get right into business. So what you're looking at is all that we spoke about in the previous video. And the way that I'm going to be teaching is I will always refer to where we started. I don't want you getting confused. So we'll start by talking briefly about what we already spoke about. In that way, it makes more sense because then it's one part. We're taking the part that we built last time, and then we are putting it together with what we are going to talk about today. Okay, so this is what we built. This is what we put together. And we said that this is the pre-opening range, 7 to 7:30, and then 7:30 to 8:30 is the opening range. We discussed smooth edges, as we see here. Okay, so from 7 o'clock, we wait and we look and observe what price has given us. We got smooth edges. What makes it a smooth edge? This high did not take out this high. So then we have a smooth edge. And also, we got a smooth edge on this side. What makes it smooth is because this low did not take out the previous low. So now these are both smooth on both edges. So do we know which one is going to be taken out first? No, we don't know that. So we wait, and only after 7:30, we look to see which side was taken out. In this case, price moved below, so it made this side jagged. And once we have that, we now have bias. We know that these smooth edges are a magnet to price. But does it mean that price is going to go up there in the next session or between 7:30 and 8? No, it might do it later on. Okay, so once we have this, once this has happened, once price goes below these two, you want to mark out any fair value gaps that you might see in the price leg that went below to take out price, the price leg that disrupted, the price leg that raided the equal lows or equal highs. If it had taken out equal highs, that price leg, you want to have a look at it and mark out any fair value gaps that might be in that leg. So I'm going to extend this one here. Why? Because as price was going below and it disrupted these lows, it then went up, trading through the fair value gap, which then makes this fair value gap an inversion fair value gap. What we also do as price goes up to take out these highs, we also mark out the fair value gaps that would have been formed as price went up. Okay, we mark all of them. And then we'll observe what price does when it returns back here. Does price come back and trade through this inversion fair value gap? Or does it trade here and go back? Or does it come and trade into this one? We observe and learn what the market does when it reaches all these price levels. Sometimes you need to go in your chart, as I said before in the previous video. You have to go in your chart and see these things and study them. ICT can talk and talk for 100 hours, and if you watch his videos, if you binge watch them as if you're watching Netflix, you are never going to get this. You have to go in your chart and annotate all of these things like this through so many charts. Annotate it and study what price does. So let's just run through this quickly, and then let's move on to the real chart. So this was prior to 7:30. Okay, so we start looking at price action right here. What is price doing? It presents us with smooth edges on both sides. We don't know which one is going to be taken first. So price decides to go and take out the ones that are below. Okay, it takes out these lows. And what did it do? It formed a fair value gap as it was moving down, and then we marked it. It traded through it, and this became an inversion fair value gap, and it also created another fair value gap right here. Okay, and then what did price do? It rallied up and took out these relative equal highs. Let's move on to the real chart. So we are looking at the Euro USD chart for 16th of August 2024. Pre-open range, opening range. Price moved below, it came up, moved down, and right here we start the hunt for equal highs or equal lows, relative equal highs or relative equal lows at 7:30. We do get them, and we annotate them as follows. So we've got this. Hey, what's going on here? Sorry about that. We've got this, and we've got the below. Okay, which would the lowest being this one, because this did not take out that, and this did not take out that. That's how we have smooth highs and lows. Okay, then price went to do what after 7:30? It disrupted this smooth and made it jagged. Okay, if you look at the line there, you see it made it jagged. Then we spoke about the price leg that makes price jagged, which is this price leg. Do we have any fair value gaps that were created here? I pointed it just now. That's the one. So we mark it out. Okay. At the time this fair value gap forms, you won't have this leg. Okay. So when it forms, you can just extend it. When price trades through it, what does it become? Inversion fair value gap. Okay. Then what happened after that? Price went down further. Okay. Is there any fair value gaps? Yes, they are. I see this one. So we'll mark it out. Now I'm going to take it below because this here, what you see this week, that week is volume imbalance. We call it volume imbalance. That's what ICT said in his video. Go back and watch it. Go and watch and then come back here, because I'm not saying everything that ICT said in that video. So we mark that out as well, right? And then what did price go on to do after that? Let's extend this. This is what you do every day as you're observing price, okay? You are not trading, you are observing, you are studying the chart. So we got an inversion fair value gap. Price goes down, it returns back to where? The inversion fair value gap. Okay? And then what does it do after that? It runs the smooth edges. Price comes, taps into that, and then comes down to take out the smooth edges. To do what? To make them jagged. Okay, this is all price does. Price either goes up or down to find inefficiencies and liquidity. That's all it's doing all day long. Okay, so that's what you do. That's what you do. That's what you're studying when you're looking at your chart. And then price went down and did what? It stopped here. Then when it stopped here, what did it create? It created that. Now I know you're asking. You're asking yourselves to say that I said that we are not looking at this price leg. Yes, but when you become advanced, you can use this as a reference point. Also, if you're trading, if you've traded up here, you can use it to say, okay, where can I target? Because then if you trade here, it means that you're only going to exit here, which is also good. But if you want to hold for longer and then you are experienced, you can try to aim for this. What do we also see down there? We also see an inefficiency down here. Okay, this is why you always mark out all the inefficiencies in liquidity. So we see an inefficiency here, which price traded into, and then what did it do? Then it went up. Okay, so even if you look at this at a bigger picture, let me just make this so you see. What did price do? What do you see here with this whole price action? Okay, price went up, right? Did everything it did, and then it created what here? It created smooth highs. Have a look at this. It did smooth highs, okay? And then what did it do? It went, traded through the smooth highs and made it jagged. After it had made it jagged, what did it do? It came back down to fetch what? To come and make these smooth lows jagged as well. That is all price does. That is all what price does. Price moves to find liquidity or inefficiencies. So, could you have taken a trade here? Definitely, yes, you could have taken a trade. Where could you have taken a trade? Where could you have taken your trade? That's what you want to know right now. I know when I was starting, I used to hate just starting things. I wanted to know, okay, fine, so where could I have entered the market? I can see what price did, but where would I have entered the market? Right there. Right here is where you would have entered, right? So, guys, I cannot stress this enough. You have to go on your chart, watch the videos, go on your chart and annotate these things. A lot of you are trying to keep up with ICT. He's done so many videos on this mentorship, on this 2024 mentorship. Okay, you've watched all of them, but you haven't understood anything just yet. So rushing doesn't always guarantee that you are going to arrive at your destination quicker. So take your time. We are only on the second video because we're taking it very, very slow. I've been helping people. I've been helping people through my Telegram. If you want to reach out to me and ask, sure, you can. I'm going to leave my link for my Telegram in this video, and feel free to send me a screenshot of your chart if you want to ask something. I might not guarantee that I'll respond right away, but when I get time, I'll definitely respond to you guys. So on the next video, we'll be talking about new day opening gaps and new week opening gaps. Till next time, cheers, keep up.